and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on European retailers, and my guest is Joachim Klement, Head of Strategy at Liberum Capital. Well, by several metrics, European retail stocks don't look particularly attractive at the moment. The Stoxx 600 retail index is up a meagre 9.5% this year. That's less than half the gains seen in US retail stocks. But its price-to-earnings ratio is a high 23-1, and its dividend yield isn't that great either, at just above 1%. Its top three holdings are Gucci owner Kering, Zara owner Inditex and H&M. Those are all brands that suffered heavily due to COVID-related lockdowns amid a backdrop of declining consumer confidence in the Eurozone as governments ramp up new COVID-related restrictions. So, how should an investor approach this sector? To find out, I'm now joined by Joachim Klement of Liberum Capital. Hi Joachim, so why have European retailers had such a bad year compared to their American counterparts?
You've already alluded to one big reason, which is that across Europe, different countries had more severe lockdown measures, which prevented a lot of consumers from spending money, not just on clothes and shoes, but also to just go to the movie theaters, etc. But there's another reason, namely that European consumers are sitting on an awful lot of excess savings. We estimate about 600 billion euros that are in excess savings in European banks. And so far, they have been very reluctant to spend that money because they weren't quite sure whether they would keep their jobs after the furlough schemes ended. And now that the furlough schemes ended, we get that Omicron wave, which leads to another lockdowns. So the consumption recovery compared to the US has been much weaker and is lagging behind.
European retailers are also struggling at the moment with global supply chain issues and higher prices for their goods. How transitory is that problem? How will the outlook look into 2022?
So we see already in the UK and across Europe declining wage inflation, which is a good sign because that is a key cost component for a lot of retailers. Energy price inflation will remain high throughout winter because we are facing gas and energy shortages in general. But we are confident that as we move out of the winter season, energy inflation will also decline, which should also contribute to lower inflation and reduced cost pressures.
But with so many headwinds facing the retail sector, are there any things to like here?
Yes, we do like a lot of retail stocks in general. In particular, we prefer companies that are more in the discretionary or even luxury retail spending, where a lot of the excess savings eventually will go as soon as Europeans can consume more. So in the UK, for example, Watches of Switzerland Group, which, as the name says, sells luxury watches, Kering, the European luxury retailer, these are companies that we like across Europe. Another company that I particularly like is because we here in the UK have a housing boom, and with a lot of housing renovations going on and increased environmental and energy efficiency standards in UK homes, a lot of money will be spent on renovation and improvement, which helps building material and construction retailers like Travis Perkins, for example.
At the luxury end of the market, in those companies you mentioned, is demand now so much focused on Asia that they've become quite divorced from economic and coronavirus problems here in Europe?
Yes and no. Watches of Switzerland Group that I already mentioned is very much focused on UK only. So it is directly linked to the recovering consumption in the UK. Kering, very much a global brand with as so many luxury retailers, a lot of sales to Asian customers in Asia. And that is also where the problem starts for Kering compared to other luxury retailers like LVMH, because Kering, basically most of the revenues from Kering come from Gucci, is much more reliant on international travel. Gucci apparently is a brand that is predominantly bought and purchased by tourists. And obviously with travel between Asia and Europe having stalled for much of the last 2 years, that company struggles more to recover than other luxury retailers.
Well, thanks so much for that insight, Joachim Klement, Head of Strategy at Liberum Capital. Well, before I go, here are some of the top stories in this space. British online fashion retailer Boohoo warned on its annual profit for a second time in 4 months. It blames higher returns, inflation and disruption to international deliveries. It said the new Omicron variant could cause more uncertainty and further returns in January and February. Its shares sank on Thursday, bringing year-to-date losses to about 65%. Apple is delaying its return to office plans indefinitely. That's according to Bloomberg News. While the company said it's closed 3 stores in the US and Canada after a rise in COVID-19 cases among employees. Apple's employees were previously set to return to the office on the 1st of February. The report says those plans are now shelved due to the rapidly spreading Omicron variant. And US home improvement retailer Lowe's forecast 2022 revenue below estimates. The company said a pandemic-driven surge in demand would fade as the economy and shopping habits returned to normal. Lowe's stock has benefited from the pandemic and has been trading at record levels since it raised its outlook for the current year, citing strong holiday spending. And that's your roundup of the European retail sector. I'm Elena Casas, and this is Reuters.